This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow the podcast on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you are listening to episode 38. When you get a chance, if you like what you hear, it would be awesome if you rate and review the podcast on iTunes. This really does help because I would love the feedback. For this episode of the Planet MicroCap podcast, I spoke with Rupert Hargreaves, editor of Hidden Value Stocks newsletter and value reporter at valuewalk.com. Rupert's website, valuewalk.com, has a vast amount of information and resources related to value investing, including investing book recommendations and stock screeners based on strategies put forth by well-known value investors, as well as interviews Rupert has conducted with well-known hedge fund and portfolio managers. One aspect I love about investing is the application of principles that were successful for investing in one asset class and if they can be applied to investing in another asset class. The goal for this episode is to learn more about some of the greatest investors of all time, resources available at valuewalk.com, and Rupert's favorite lessons he's learned in his conversations with hedge fund and portfolio managers. Thank you again for tuning in to episode 38 of the Planet MicroCap podcast. Please enjoy my interview with Rupert Hargreaves, but first, a word from our sponsor. Hey everybody, Robert Kraft here, your host on the Planet MicroCap podcast. I'd like to take this moment to invite you to join me and some of the guests you may have heard on this podcast to our annual MicroCap Investor Conference, the Planet MicroCap Showcase, April 26th through April 28th, 2017 at none other than the Planet Hollywood Resort and Casino in Las Vegas. The Planet MicroCap Showcase will be 2.5 days of company presentations, networking opportunities, an educational workshop, and you'll get to meet privately in one-on-one meetings with company management of undiscovered and well-known microcap companies. There are a lot of surprises in store, and you're not going to want to miss it. So join us at the Planet MicroCap Showcase, April 26th through April 28th at the Planet Hollywood Resort and Casino in Las Vegas. For more information, go to www.planetmicrocapshowcase.com and register now to reserve your spot. See you in Vegas. For this episode of the Planet MicroCap podcast, I have Rupert Hargreaves on the program. Rupert is the editor of the Hidden Value Stocks newsletter and value reporter at valuewalk.com. Rupert, welcome to the Planet MicroCap podcast.
Thank you for having me.
It's an absolute pleasure to have you. Thank you for coming on. So, as we usually do when I start the interview, what is your background and what is your experience with microcap stocks?
Well, my background, I started off in the City of London doing proprietary currency trading. And when I got bored of this, which happened very quickly because it's a very stressful game, I wanted to carry on investing. I enjoyed finance, I enjoyed the markets. So I started doing reading and looking at other different styles of investing. What I thought, trying to understand the subject and trying to build a real good understanding of everything and the best way to deploy my capital, because at this point I didn't really understand the stock side of it, because currency trading is all about speculation, really. You're just betting on things going up and down with no real, you can try and predict the macroeconomy, but that's just a waste of time. And then stumbled across the Bible of value investing, The Intelligent Investor. And really my obsession with value grew from there. The love of investing in a business and assessing the fundamentals. And from there, the more reading on the subject you go to, you avoid large caps because everyone can get any information on large caps. At a click of a button, you can find out everything you could possibly want to know about Apple or ExxonMobil or something. But with microcaps, it's different. It's a different game altogether. These are the stocks that you have to dig real deep to find the mispricings, and so there are more mispricings. And that made a lot of sense to me. It's like, okay, some of the world's best investors made their name in microcap stocks because this is where you can find the good businesses trading at cheap valuations. And it was just a natural progression from a love of value investing, a love of fundamental investing to microcaps, where you could look at this business and say, I understand this business because it manufactures tiles or something. Everyone can understand that. And it has 15 shops. That's really easy to understand. And that love of the business and finding these mispriced opportunities is what took me to microcaps. And I've been doing that full time for about 10 years now.
Nice.
Which isn't long compared to most people, but it's long enough to know not what to do.
I was going to say, in some circles, you're now 10 years old. Congratulations.
Thank you. Well, it was Walter Sloss who said that the first 10 years of investing are the most important. Because unless you've done 10 years, you don't know anything about the game. So you're going to make so many mistakes in those first few years.
Mm-hmm. So what brought you to ValueWalk.com and HiddenValueStocks.com? How did that germinate? Where did that start from?
Well, ValueWalk was a natural progression. After my transition away from foreign currency towards stocks, I wanted to learn more about the subjects, and I found one of the best ways of doing this was writing. So I started a blog, and I mean it's really informative when you go and write about something. And I can sit there and I can write for hours. And when I'm writing for hours, I go and look at all the different component parts that make something, give birth to an idea. And then I thought, hang on, stock investing is not, when you start out, you're not going to make a lot of money from it really quickly. And even if you wanted to, it means you can't hold on to the positions for as long as you want to. So I started doing freelance financial writing as a sideline, something I enjoy, I could make some money from, and I could also learn from it. And that's when I came across ValueWalk and applied to come and write some value-orientated topics. Mm-hmm. And it just blossomed from there, really. Grew out from a one article a week contract to what it is today, which is as many articles as possible on as many subjects as possible. That's how it worked. It just worked well because it was something that I wanted to write about and something that came easy to me, and a site that wanted to get that information to readers who like the subject.
And then also, and Hidden Value Stocks. How did that come about?
Well, Hidden Value Stocks, this is something that came out of around this time last year. I started doing interviews for ValueWalk with famous investors, and well, not so much famous, but value hedge fund managers who fly under the radar.
No, in these circles, famous. They're totally cool saying
exactly. I mean, if you look at a guy who's achieved 35% per annum for his investors over 5 or 10 years, which some of these guys have, they should be famous, but they're not because they only have 200 million under management or something, which doesn't quantify. But I started talking to these guys, and that became a weekly thing. And this was started. I wasn't actually as part of this to begin with, and I came in because it was something I was already doing, so it didn't make sense to replicate it twice. And I wanted to put a lot more time and effort into these guys are very clever, so you want to be able to sit down, have a conversation with them, talk about their ideas, talk about how they got in the game, how they analyze companies. And that's not really something you can do when you're trying to write a short interview that becomes has a sort of template every time. So that's why we brought out hidden value stocks this is 35 pages each issue, and that's 2 hedge fund managers. And we dive deep on 2 of their ideas each. So that's 4 ideas in total. Mm-hmm. And that's so much more content than what we had before, which was about 1,500 words with one manager and maybe touching on a few ideas. Mm-hmm. And it was a natural progression. It's something that was going to happen at some point anyway, hopefully. Well, it did.
So Rupert, what I wanted to know is what is your goal with valuewalk.com, and why did you feel it was necessary to share the information that you have and put it all together like you did?
Well, ValueWalk was founded to sort of bring everything out there on the internet about value investing together into one place. And if you go over to the site, look at in the top bar, there's a timeless reading tab. The timeless reading has got under there's thousands of resources that cover everything from beginning in Benjamin Graham to value investing today and everything in between, how to value companies, all the different hedge funds, value funds, how Warren Buffett started, Warren Buffett's biography and all that. And we've also got a collection of investors across the spectrum. And each investor has their own profile and biography, some links to learn about their investing style, and we've got value screeners as well, and book lists, links, value investing hedge fund letters. So that's the value side, and we've also got the hedge fund side, where we cover hedge fund letters that are not available to the public, but we feel contain valuable information. So we try and put those across our network of contacts and bring out the information so people can learn from guys who are paid to do this and may have something worthwhile to say. We don't tend to cover glory hedge funds so much. Mm-hmm. Well, we have some content on them, but for us it's more, is the fund interesting? Can we add value here? A guy's going to learn something from this. We're not going to go out and profile a mutual fund that tracks the S&P 500, closet indexes the S&P 500. We want to give people information on stuff they may not necessarily be able to find or is necessarily in the public domain in a way that's legal.
So in my last interview, Rupert, we talked about various investing books, and I kind of thought that it'd be pertinent to discuss this with you as well. What are some of your favorite recommendations? You mentioned a few already, but what are some of your favorite recommendations, and why maybe some of these would be good for new microcap investors?
Well, as I already said, The Intelligent Investor, that was transformative for me in my way of viewing companies. I mean, even though it's 70 or 80 years old now, however old it is, it still teaches you to think about business as a business rather than just a stock ticker on a screen. The second one is Dear Chairman by Jeff Graham. And I did an interview with him when the book came out and read the book. And it's really, when you read Dear Chairman, you get the view, understanding that stock investing has changed significantly since the days of Benjamin Graham and when Warren Buffett first started. And today, I mean, I don't know if you've read the book or if your readers will have done, but to give a little bit of information about it, it's about activist investing over the years and how activist investing has evolved, and it goes from Benjamin Graham, who was, in many senses, the first activist investor and the first true fundamental investor, all the way through to today and how activist investing has changed. Mm-hmm. But I came away from reading this book as it's very, I mean, if you want to do well with equities, then you need to have some kind of edge. For a lot of these guys, it's activism. But it's another one of these books that teaches you to think about the company as a business, and management is really important in that business. And 90%, 95% of managements are terrible, and it's finding the ones that was probably the key takeaway from the book, is that not 95% of managements in the US are terrible, and they're not acting in their best interests of shareholders. I mean, some of the stories that this book details, and these guys paying hundreds of millions of dollars just to get rid of raiders or people they don't like on the board, and it's just disgusting how active and how they're screwing over shareholders. So that's something you need to be really careful of. Mm-hmm. And the third book I'd recommend is Inside the Investments of Warren Buffett, 20 Cases. I mean, it takes 20 of Warren Buffett's greatest investments and reviews each one. Mm-hmm. Looks at why he was first attracted to it, or tries to understand why he was first attracted to it, how the situation played out, and what he took away from it. And this is it's like the Dear Chairman before it. You realize that in a lot of these situations, Warren Buffett had an edge, a strong edge over everyone else, because in many cases he was the largest shareholder. And this teaches you to think about the stock market again from the perspective that these are businesses. They're not tickers on a screen. Mm-hmm. And it also says to you, Warren Buffett is the greatest investor, but he's had a lot of advantages over people. It's not. I mean, you could just follow him into every position, but you're not going to become Warren Buffett simply by trying to adopt his strategy and following it. You don't have the advantages that he had. So yeah, I say these three books always sort of say that how important the management is. A company, a stock, is a business, and you're not going to be the next Warren Buffett or guru investor because they have a lot of advantages over the average investor. So mm-hmm. play to your own strengths. Mm-hmm. Don't go and buy or attempt to buy. If you've just had a massive inheritance, don't attempt to go and buy half a small MicroCap and push for change, because it won't happen. But because you want to make money quickly or something ridiculous like that. So you see that's it's difficult to put into words, but it's you're not Warren Buffett.
Yeah,
you're not special. You're not special. The market will still ruin you if it wants to.
You've done some extensive work on some of the greatest investors of our time, like Benjamin Graham and Warren Buffett. And by the way, for those who haven't seen the Becoming Warren Buffett documentary on HBO, it's fantastic. I mean, it doesn't just cover investing. It talks about his life and who he is and who he.
Highly recommended.
You saw it?
Yes. Yeah.
It's amazing. I loved it.
I think the main takeaway from that has to be focus.
Yes.
I mean, they say that's the outline, where Bill Gates and Warren Buffett both write down focus, and that is his entire life has been devoted to the idea of compounding and the idea of learning as much as possible to give you the greatest edge over everyone else.
And so on that point, and I know most of my listeners probably know a bit about their investing style, but maybe you can kind of go over a little bit about, what was their investing style, and how did value investing grow from it, and then also why has it stood the test of time?
Well, I think it comes back to the Dear Chairman I was talking about it earlier, the Dear Chairman book by Jeff Graham. In this book, it describes Benjamin Graham's fight with Northern Pipeline, I think it is. And now when he first came across this stock, he had to travel to Washington, wherever it was, where the company kept its annual records, to find that the stock was actually had a book value of $100 a share and was only trading 50. That's where the idea of value investing developed from. But when I look at it now, it's the world has changed a lot since then. And there are no longer so many of these obvious discrepancies. Now, Benjamin Graham essentially invented fundamental investing, which is why he was such a big deal in the world of investing. Because in the Dear Chairman, it describes how when he was around, quite a lot of investing was done sort of speculating, just betting on the price going up. And Warren Buffett came in to do. I mean, if you go back now, you can still, if everyone knew what they were doing then, you wouldn't have the opportunities that they had. It's just simply because it wasn't as popularized. Mm-hmm. But I mean, it stood the test of time because it is buying out of favor businesses. Mm-hmm. And I think you'd say value investing has changed from buying these businesses that not many people know about. I mean, even Warren Buffett's, his most famous investments like Sanborn Map and Dempster Mill, they were not obvious investments. And only when he got involved, they became more popular. But nowadays, value investing has become more of a time arbitrage game, where you'll see an out of favor stock, and it's only out of favor for the moment because of human psychology, right? Like humans have never changed in however many thousands of years we've been around. If we see something going down, we want to sell it, we want to get out. That's the massive herds. And until humans change that mentality, buying cheap stocks in the hope that they will once again come back in favor won't change. That's why buying cheap stocks has succeeded. But value investing, as Benjamin Graham and Warren Buffett first interpreted it, is still it doesn't exist. I mean, now if you go out and buy a load of cheap stocks, it's most likely they won't be cigar butts. They will just be junk. And in a year's time, they'll be worth zero. Mm-hmm. Because the good stocks, the good cheap stocks, aren't cheap for long. And I was reading a hedge fund letter. I can't remember the exact fund, but they were talking about the oil price decline in 2014, 2015, when the price of oil collapsed. The shares of oil explorers collapsed as well. But they were looking at these stocks and saying none of them actually got cheap enough because quite a lot of people piled in trying to replicate, trying to value invest bottom fish. So they didn't actually get cheap enough to be at the stage where the risk reward was appropriate for someone who has a really high margin of safety. So the opportunities for deep value investing as it was back then no longer exist. But the opportunities for buying things that are out of favor and waiting a long time, as in time value investing, if you want to call it that way, are still there because of the way people's mentalities are.
Mm-hmm. And to kind of go off that, you make an interesting point. I think this idea of time value investing is kind of key, especially when, like a few of my guests in the past, they've talked about how, they have years upon years of journals of all their notes and on companies that they've done their due diligence on. And they may have done due diligence on a company, back 3 years ago, but, at the time it didn't really fit their criteria. But maybe 2-3 years later, you go back and take a look at that and say, oh, you start seeing what the company's been doing and seeing how it's improved or not improved over that time, and you make a judgment call then. So it seems like because there's more information. I mean, I remember in that I read Jeff Graham's book too. I remember how, you saw Benjamin Graham. He took the train down to the ICC in Washington, D.C., and that's how he was able to get, more up to date information on company financials. I mean, this is in 1914, back before the Securities and Exchange Act of 1934. But it seems now it is more about timing, because all that information is much more readily available to the masses. I mean, would you agree?
Yeah. I mean, I can, in 30 seconds, I can pick up on my screen a stock screener that tells me every stock that's trading at 50% of book. Mm-hmm. But would I want to go out and buy them, or are they all going to be junk? Mm-hmm. Or would it be better to buy a stock that looks cheap in the moment? Mm-hmm. And not looks cheap in the moment, that has fallen on hard times, like American Express last year. I mean, if you bought that and taken a long-term view.
By the way, for full disclosure, do you own? Are you?
No, I don't own. I haven't owned any of the stocks I've mentioned so far.
Okay.
No position. But say if you bought it and then were to hold for, say, 10 years, I mean, you're going to make a good profit, because they're not going away. But look at Warren Buffett. His greatest investment was Coke. I mean, I think when he bought that, it wasn't what you call a cheap cigar butt. It was trading at something like 15 or 20 times earnings. Mm-hmm. But he worked out he could grow earnings at 15% an annum or something like that. Mm-hmm. 40, 50 years later, look what you've got.
Yeah. But like, how do you quantify timing? It's very arbitrary, because I mean, you would, of course, you get a lot of people saying that it's luck, and you just happen to be in the right place at the right time, and maybe looking at that company in the right place at the right time. I mean, how, in your experience, how do you think about timing, and how do you think about even luck for that matter?
Well, there's always a degree of luck. Mm-hmm. There's always going to be a degree of luck. You can't. I mean, you try and tell me what the stock market's going to do. No one can do that. It's always a degree of luck. But the best idea, that I've seen, the best process that I use, is if you have a stock that you really like, you say it's worth $10 a share or whatever, and it's trading at 8, but you're not willing to pay more than 6. Put a limit in the market, go away, and forget about it. Doesn't hit that price, it doesn't matter. Find another opportunity. Mm. Of course, if the company then comes out in a year and says its earnings are up, then perhaps you should change your thesis. But I think it's all about setting your target, calculating intrinsic value, set your target at the margin of safety that you're willing to accept, and then go away. And the market may fall 20% in 3 months' time. You may get your opportunity to buy. If it doesn't, don't accept any. I think that's something a lot of people do, is they accept less, and they'll say, okay, I think the stock's worth 10, but it's trading at 8. I don't think I'm going to get any less, so I'm going to buy at 8, and that kind of invalidates your thesis quite a bit. And that's one thing I found myself doing a lot when I started, is chasing the stock higher and not putting that limit in and forgetting about it. I think the amount of times since I stopped doing that and started just putting a price and forgetting about it, I've seen a much better performance psychologically and in monetary terms. Because, I mean, if you buy at 8 and then it drops to 6, you're going, oh no, what have I done? Sort of thing. There was an extra load of profit in this for me. Mm-hmm. And so that's what I'd recommend.
Mm-hmm. And I'm sure that one comes with experience for sure.
Yeah, I mean, this game, I say you've got to. I mean, if you start on a load of winning bets, you're going to screw up pretty soon. You're going to screw up big. Mm-hmm. So it's just, if you do have a loss to begin with, I think that's healthy. Mm-hmm. In experience terms, anyway.
Yep. No, I've been there.
I think every good investor has to, because you learn more from losing than you
Oh,
learn from winning.
I wouldn't call myself a good investor yet. I'm still learning.
If you don't stop in this game.
Oh yeah, no, I'm addicted. I can't help it. That's why I like to talk to you and other people on this podcast, because it only helps, and I love learning from each and every one of you. But and one thing you actually did just bring up, like an answer ago, was the idea of the stock screeners. You can put any a screener for anything that you want, and you can find it. But you happen to feature a lot of these screeners on your on valuewalk.com that I thought were really fascinating. So for my audience, can you provide an overview of a few of the screeners that you feature and why you do that?
Just have a look here and see. Well, the ones that I've used actually a lot personally in my past are the raw charts screener and raw charts data. I like, because these you can pull up. I mean, the thing I like about it is it's not complicated. It's they've got 100 different metrics, 10 years of fundamental data, and you can pick up one, say price to book. How's a stock traded at price to book over the past 10 years, and it shows you there on the screen, or what's the PE ratio every quarter for the past 10 years, and that's really helpful, because it's just simple, and it's there in front of you, and there's not too much. I find a lot of screeners can be very complicated, and also I think if I'm going to use a screener, I want to. I'd only use it as a starting point. I think a lot of people depend on them too much, and a lot of times the data is misleading because it will come from the last quarter or something, and then you go and do the fundamental research. They say, "Hang on, this company's just issued 500 million of debt, so that those figures are completely out of." But I'm going to be naughty here and mention a screener that we don't have on Value Walk. There's actually these guys I've had some association with in the past. They're a UK company called Stockopedia, and they have very, very good. It's only 5 years worth of data, but it's presented in a very visually pleasing way. Traffic lights, all that tell you green is good and red is bad. But they also compile various ratios like the Altman Z-score, and they put together screeners based upon their data, which I've found to be one of the more reliable data sets. I can't stress how important that is to have good data for a screener, because it can really throw you off and waste a huge amount of time. And that's what I've, especially doing research for stocks when I'm writing about them. I would say a good 80% of the screeners that I've used have been misleading.
But like, I wanted to know, for instance, like the Graham Dodd screener you have on the site. What's the point of having that up there for people to go and check out and look at? What was your goal there?
It's basically just an idea. I mean, there's always ideas to throw up. So what is this? Back testing. Yeah, it's got a back testing figure. That's one thing I don't like, is back testing figures. I feel like in this game there's a lot more things you don't like than you like. It's always good to be very critical and skeptical about things. But yeah, the Graham formula screener, I've not actually used it myself. But I think what we've tried to do at Value Walk is just compile the biggest amount of data and information that we have, and if that includes stock screeners that we think can offer value and be a good starting point, then they will be included.
So another thing that you brought up a bit earlier is that you've done interviews with hedge fund managers and portfolio managers. What were some of your favorite lessons that you've learned from some of your conversations that you've had?
Well, when I first started doing this, I wouldn't say young and inexperienced, but still in awe that I could interview these people. So what I really like to do is ask them what their biggest mistake was, because I felt like I could learn a lot from this. And I think I have learned a lot from this. And this is probably the favorite thing I've learned from them, is when it comes to mistakes, everyone makes them. And they usually come from investing outside your field of competence, or not understanding the idea in the first place, which are fairly similar linked. And outside of that, it's the traditional things like getting out too late or getting in too early or stuff like that. But that's also been a running theme through the interviews that I've had. A lot of these guys do really, really detailed. It's the stuff that the average investor can't do, like 2 or 3 weeks studying a company before even deciding to see what the management's doing. Just to really get in there and know everything and try and understand not where the company's going, but where the industry's going, and what are the competitors doing? Why isn't this company doing that? It's really knowing your field. Mm-hmm. And it's difficult for the average investor, because obviously I can't do that much research. I have a job. I can't go and visit all these guys. But it's important to know what you're doing, what you're looking at. Even if it's only a few days of research, don't rush into anything. And you will make mistakes, but the thing is if you have a really good investment thesis and you think you really know the topic and the company, if you lose, then so what? You've done the research. Then you haven't made a mistake. It's just been a bad investment opportunity. So as long as this is the biggest mistake is not doing your research properly and rushing into something. Mm-hmm. Take your time. That's probably sums it all up. Take your time. Don't rush into anything.
Mm-hmm. So I think that actually probably ties into my next question. What is then your advice for new microcap investors?
Well, take your time. try and understand not just the company, but other companies as well. Mm-hmm. Especially in the microcap area, you've got to be so careful, because if you go and see a company and say, "Oh yeah, we've got the best new thing, hot new gadget, whatever it is, we're doing 70% gross margins, and their competitors doing 20% gross margins," 70% isn't good. That's a reason to go and say, hang on a second. If anything, this is going to be dodgy. There's probably some fraud going on here. Mm-hmm. So I say, do your research and always ask why. Mm-hmm. And the third thing, which for me is the most important, I've always found it when looking at companies, the first thing I would look at is cash. Mm-hmm. Cash tells you a lot. Cash on the balance sheet, and cash generation. Mm-hmm. If those two things are there, then you're a pretty good starting point. Mm-hmm. If you've got high debt and little cash generation, don't even bother looking at it, because it's, no matter how cheap it is, it's not going to work.
Mm-hmm. Cool. And so, we're about to wrap up here, Rupert. Where can my audience go and find more information about you, your articles that you've done and you've put out there? Well,
you can find all about me at Value Walk. I cover hedge funds and value investing there. But if you really want to, listeners really want to come and have a look at something interesting, head over to hiddenvaluestocks.com, a new newsletter we published, which we published. We've got a new issue going out at the beginning of next month. We've got 3 interviews in it this time instead of the usual 2. And we've got one of the funds in it is compounded at 35% per annum for 5 years. This guy's pretty switched on. He knows what he's talking about. He's had some great ideas. I think last year he was up, I can't remember the exact figure, but it was around 50% or more. He's a really, really nice guy, really intelligent as well. So check that out. You can have a look at a free teaser and download 1 issue or subscribe for a year. And we've also got some free content on there as well. And of course at Value Walk, that's where you can find everything else.
Cool. Well, Rupert, thank you so much for your time and for joining me today. Have a great weekend and stay warm.
Thank you very much for having me. I will try.
Thank you.
Cheers.
Thank you all for tuning in to the Planet MicroCap podcast, and thank you, Rupert, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@stocknewsnow.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of stocknewsnow.com, the official microcap news source, and the Microcap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap podcast. Have a great week, everyone.